Okay, 3 o'clock. Welcome. This is our second in a series on the Payroll Protection Program loans that Clayton McCurvey has been hosting. Maybe take a quick look at the screen and take a look at some of the things that, some of the offerings we have for you to stay connected with us. Our entire team is working hard to stay on top of a lot of the changes that are occurring, and this will give you an idea of where hopefully you can find Sarah, myself, Ben Smith, other teammates between LinkedIn, Facebook, WeChat, and so forth. So hopefully that'll be valuable. So for those of you who weren't here last time, introduce myself, Tim Hilligus. I'm a shareholder at Clayton McCurvey. Along with myself, Sarah Russell, a fellow partner of mine in our tax department, and Ben Smith, one of our senior managers. And Ben's going to help out today. One of the things that overwhelmed me in our last webinar was the questions. And with over 200 participants, the questions come fast and hard. And I thought with Ben involved, we can maybe get through some of your questions, both offline and online at the same time. Just a little quick overview of our firm. We work with closely held companies, and hopefully that's where a lot of you fall in. Entrepreneurs who have business global business. And I think one of the things that's changed in our business, just like yours, from working remotely, is since March, we've had a pretty heavy concentration on the payroll protection program between the law itself, the updates to frequently asked questions, and the interim final rules that come out that hopefully will help us be a better resource to you over time as we gain more information. So a little bit logistics and a little housekeeping. Ben and I will be behind the scenes, hopefully answering questions, but also interjecting into Sarah's presentation at hopefully appropriate times with some of your questions where it's relevant to her presentation. We are going to handle questions real time, so please go ahead and submit those. And then another key component in the question section is you can actually upnote those. So if you find a question that's relevant to your business or on your radar, by all means, if you look on the right side of that question, you'll see an arrow, an up arrow. And if you wouldn't mind clicking on that, and that'll let Ben and I kind of sort through what are the most important questions on there. And the final thing we'll do is we're going to end at 4 o'clock. So those of you who are familiar with me for the years in my CFO roundtables, we end right on time. So we will end at 4 o'clock. What Sarah and Ben and I will do is we'll continue to answer your questions throughout the afternoon as best as we can. And we'll go ahead and post those just like we did last time. You'll have access to the Q&As, and you also have access to the presentation. So I want to thank Sarah and Ben for the time and effort putting this together. I know as late as yesterday, Sarah was dealing with the most recent Q&As, so we all greatly appreciate that. And now I'm going to turn it over to Sarah. Thanks, Sarah.
Sort of let everybody know from last week's webinar, Tim, in fact, cannot see you. We had a few questions as he was joking around, waving at people. He was kidding. He cannot see you. You are not visible on the webinar. With that, we'll get right into it. So just to give you a little bit of a recap on where we stand today with the PPP, the latest statistics, after the second round, there's, as of May 1st, about $176 billion has been approved. Yesterday, I heard that about $80 billion was still available as of yesterday. So we thought that the second round was going to move really, really fast. It did, but it seems to be slowing down a little bit and normalizing. The one important thing that I wanted to mention on here is that the average loan decreased from the first round to the second round. In the first round, it was about $206,000. And in the second round, it was about $79,000. And I'm just putting that statistic out there as we talk a little bit more about some of the things in the guidance that have come out and some of the things that we talked about last week. So if we briefly recap what we talked about last week, a lot of the questions that were out there are still unknown. We talked a lot about what are the definitions in the loan forgiveness provisions, and how are they going to be interpreted by either the SBA or the Treasury Department? And these questions have mostly still not been answered. So here's a high-level overview of the items that we're still waiting to hear. what is the definition of incurred and paid? And I'm not going to go through all the hypotheticals that we went through last week, but just sort of a refresher that these are still the unanswered questions. The definition of rent, we're still waiting to hear what that definition is going to be, and whether or not you, if you have a triple net lease, if those extra costs will be able to be included, how will self-rental be treated, what is the definition of covered utilities, and specifically, what are transportation costs, the definition of mortgage interest, the definition of payroll costs. Certainly, there's a lot of uncertainty surrounding what that definition is, and then clarity surrounding the covered period and some of the questions surrounding that June 30th date, meaning, if you restore your FTEs by June 30th or you restore compensation by June 30th, how do those calculations work? We're still waiting to hear. Our advice today still remains the same as it was last week, and that's sort of to, plan for the best and prepare for the worst, meaning, pay what you can in the 8-week period, prepare to have a payroll run potentially on the last day of your 8-week period to maximize costs paid, strategize what type of costs you might be able to include in that 8-week period, but also plan that maybe some of those strategic decisions that you might be able to make may be disallowed as guidance comes forthcoming. Tim, did I miss anything there?
That's a great summary. Thanks.
Okay. So where we left off last week, there was a lot of discussion around FAQ 31 and FAQ 37, which was that FAQ that addressed large companies, both public and private, with adequate sources of liquidity obtaining these funds. And those FAQs said that that companies with adequate sources of liquidity were in fact not eligible to obtain these loans and should reassess their certification that was required under the application of the loan. Last week, Secretary Mnuchin came out and announced that loans over $2 million will be fully reviewed before there is loan forgiveness. And subsequent to last week's webinar, FAQ 39 came out and said the SBA will review loans in excess of $2 million, sort of piggybacking on what Secretary Mnuchin had said, in addition to other loans as appropriate, following the lender's submission of the borrower's loan forgiveness. And that guidance implementing this procedure is forthcoming. So we don't know exactly what that's going to look like and what those reviews will entail, but we do know that the SBA intends to do some sort of review. The FAQ, or there was also an interim final rule on requirements for promissory notes, authorizations, affiliation, and eligibility issues. And that interim final rule was really addressing that the administrator did not believe hedge funds and PE firms are eligible to obtain PPP financing. So that was last week's webinar. This week, we have a whole new slew of some guidance that's been issued that we want to address. And I'm going to go through, instead of going through these in order of the dates this guidance was issued, I'm going to go through in the order of what I think are going to be the most impactful issues that are out there. On April 30th, the IRS issued a notice that indicated expenses paid from a PPP loan that is forgiven are not deductible. So contrary to what our belief was last week, I think my comment on this issue was that I had heard that there are some conservative opinions out there that thought that this may be the case, but we thought that this was contrary to the intent of the law. I still have that opinion, and Senator Grassley has issued a statement that the notice is in fact contrary to the intent of the PPP, and Representative Neal, who's on the House Ways and Means Committee, indicated that a fix to this issue could come with the next legislative response. However, on Monday morning, Secretary Mnuchin defended the IRS guidance. All of that to say, sort of plan that these costs will not be deductible, and wait and see if maybe in the next round of guidance or the next legislative stimulus package that comes out, if Congress is able to, in fact, fix this issue. In addition, FAQ 40 came out and provided a little bit of clarity. One of the questions we had last week, and we've gotten from our clients across the board, is what happens if I have laid somebody off and I offer to rehire that same employee for the same salary and wages or the same number of hours, and that employee declines my offer? Are they going to count against me on my FTE count for purposes of my loan forgiveness reduction? And the SBA came out and said, nope, we will not count that person against you as long as you have documentation to prove that you have offered them to be rehired and that that employee declined the offer. We don't know exactly. We believe that that declinement needs to be in writing, although the FAQ said that they would issue further guidance on this forthcoming. So we'll see exactly what they're going to look for. And they did remind everybody that employees who reject offers of reemployment may forfeit eligibility for continued unemployment benefits. So I think they put that in this FAQ to remind everybody that you can't just sort of wink, wink, nod, nod. We have offered you reemployment, and the employee is going to not accept that offer of reemployment and continue on unemployment benefits. It's sort of a reminder that if you have an employee who declines an offer, that they are no longer eligible for those unemployment benefits. So they're trying to put some guardrails around how that FAQ is going to work. And I suspect that once we get real firm guidance on this specific FAQ, we'll know a little bit more details.
Yeah, I think, Sarah, that you bring up a good point that they don't want you to use this option as an ability to purge your workforce. You've got to make the offer and the employee must reject.
Correct. So today or yesterday, we also received FAQ number 43. And this FAQ, if we go back to FAQs 31 and 37, they had issued a safe harbor in those FAQs that said, if you reassess your certification and you no longer believe that you qualify for a PPP loan, you have until May 7th to return the funds and there will be no harm. We've yet to get any guidance on what adequate sources of liquidity means. And the administrator has recognized that there are a lot of questions and there's a lot of controversy around some of these pronouncements that have come out. And they are still in the process of drafting that guidance. And so they've extended that date to May 14th. So if you reassess your certification, you have until May 14th to repay those funds. And hopefully we get that guidance before May 14th, before May 13th. Hopefully we get them soon. I looked about 30 minutes before the webinar started. There isn't anything new today. So I have nothing more to add to that other than we suspect that, you should have a fair amount of documentation to support why you believe your certification is intact and why you don't believe you have adequate sources of liquidity as defined. And, that documentation, certainly I think we'll have a little bit more clarity before next Thursday on what that will include. As well as maybe and hopefully some sort of bright line test that will tell lenders what to expect. On April 30th, there was also an interim rule on corporate groups and non-bank and non-insured depository institution lenders issued. And there's two key takeaways on this interim rule. The first one is it says a single corporate group cannot receive more than $20 million of PPP loans in the aggregate. And what that means is if you have a corporate group made up of multiple subsidiaries, original guidance in the law indicated that each single subsidiary would apply for their own PPP loan. And this rule is saying, it also indicated that each single subsidiary would be able to apply for up to $10 million. And this interim rule indicates that, in fact, if you had 5 subsidiaries, all who could qualify for $10 million, as a group, you would only be able to receive $20 million. There is also language in here. Last week we talked, one of the open questions was, well, what happens if I get this loan and I use it for something that's not authorized under the legislation? Or what if I don't use all of the funds by the end of the period, June 30th? Our assumption was it would just flip to a loan that would be payable over 2 years with an interest rate of 1%. And there is language in this interim rule that also indicates that that is the way the SBA is going to interpret that. This is a little bit different than whether or not your certification is valid, but this is really goes back to the use of those funds. And the language in here indicated that if a single corporate group received more than $20 million, it would be deemed to have unauthorized uses, and there would be no eligible forgiveness for those unauthorized uses. So I think that we're still leaning towards that path, that you wouldn't be required to return all of the funds immediately. You just wouldn't be eligible for forgiveness. And then FAQ 44 was also issued yesterday, and it made it clear for purposes of determining if you meet the employee size standards, businesses must count employees of their U.S. and foreign affiliates. There's still a few questions on this FAQ. There was some legislation or an interim rule issued that alluded to only counting employees in the U.S. However, this FAQ sort of referred us back to the original rule included in the SBA, and that original rule indicates that you must include all employees, not just employees resident in the United States. So while this FAQ is issued, I think there's still some questions surrounding how this rule will really be applied. And then the final piece of guidance that's been issued, and not too critical for most people in the audience, but in the event that there are nonprofit, religious, or educational institutions in the audience, they have said that you are still entitled to the same exemptions provided in the federal non-discrimination laws, meaning if you are an educational institution that is, like a Catholic Central high school, for instance, that is only male, you don't have to follow the same non-discrimination laws that are generally included in the SBA regulations. You can follow the same federal non-discrimination laws that you are already following. And then they also put in here that students who are part of a federal work-study program don't count for determining the number of employees for PPP loan eligibility, and their payroll should not be included for determining the maximum value of the loan. I'm going to go back now for a moment and sort of go back to talk about this adequate sources of liquidity and the documentation that we think, or we're hearing from attorneys, may be required. I'm going to let Tim sort of chime in here and let us give us his thoughts.
Well, Sarah, I want to go back and ping pong it right back to you on one question that's popular, and it goes back, I think it's your 6th slide discussing the Internal Revenue Services interpretation and basically applying Section 265 to the non-deductibility of these expenses. And the question is I'm not sure it's clear to everyone out there that while we've lost the ability to deduct these expenses, the reason is because the forgiveness of debt is not income. It's exempt income. So maybe you could just restate that.
Yeah. So in the original legislation, for this program, Congress made it clear that to the extent your loan was forgiven, it would not be includable in income. Meaning, generally speaking, if you have debt forgiven, you must pick up debt forgiveness income. And the congressional legislation made it clear that this would not be considered debt forgiveness income. But there is a law or a statute in the Internal Revenue Code that indicates that to the extent you have tax exempt income, you cannot deduct expenses against that income that created that income. So, you generally think about exempt interest income, and you may have some expense against that. Those expenses aren't deductible. And the IRS is looking at this as exempt income. And so they have taken the position that the costs that you are incurring against this income are not deductible. And those costs are going to be your payroll costs and your rent costs that you are seeking for forgiveness. And so they're sort of looking at it saying, you can't double dip on this. It's not excludable from income and you get the deduction. That's a double benefit. However, the congressional statements that have been issued by both Grassley and Representative Neal have seemed to indicate that that was actually the congressional intent. Was they recognize that small businesses need liquidity, and that including this amount into income would be a detriment to that liquidity. They didn't want this to be taxable, but we really can't determine where this will end, especially if Secretary Mnuchin is sort of in support with the IRS guidance. When they negotiate the next round, this may get left out. It may not be enough of a pressing factor for them to argue over.
Yeah. Well, thanks. So let's kind of just briefly talk a little about the handoff that Sarah gave me, which is, we're in a position of having various gatekeepers, and what do? None of us are comfortable with the fact that there's these ambiguities or there's undefined terms. The word right now being thrown around is necessary. And Sarah and I have dealt as CPAs in the tax world. You deal with necessary in a few different areas. One is the necessary business expenses of like meals and entertainment. And there's another larger one where they define necessary for accumulated earnings tax. But in this case, we're not sure. We're not sure what do they mean by necessary. You've got a couple of gatekeepers that you got to deal with. Number one is the bank ultimately or initially determining your forgiveness. And the second is the SBA. And they've got 60 days to approve your forgiveness application or process. And it's not likely they're going to get through reviews of all of those. So we would envision some kind of oversight occurring probably for months or maybe a year. So what are some of the things that you got to do? You really got to put yourself in a position right now to document and understand, where was I at when I made this application? How can I put myself in the best position possible to ensure that I'm qualified for this loan, and more importantly, I'm qualified for forgiveness? Our suggestion is to document correspondence between yourself, your customers, your vendors. Think of all those things that may have instilled this uncertainty for you, whether it's a potential slowdown in work, whether it's the loss of key employees to COVID or COVID in their family, whether it's loss of a key executive. What are all those things that might impact your business and therefore meet that qualification at the time of the application? The one thing that nobody can really guarantee is we don't know what the poll of what the popular opinion is going to be. We've already seen that with the questions that Sarah addressed earlier. When you hear about the LA Lakers and Shake Shack, that comes from public pressure. And so between the law, the IRS, Congress, perhaps the president, the SBA, and your bank, everybody's going to have their opinion on this. And at the end of the day, somewhere down the road, months from now, you're going to have this hindsight vehicle that may not look so good. Now, hopefully we'll get some good news from the Congress with respect to the deductibility of these expenses. But documenting potential cash delays, requests from your customers to postpone cash flow, vendors who have indicated to you that they anticipate a slowdown in the chain of resources. I mean, these are all things that are going to help you document the potential or mitigate the potential argument that you didn't meet the qualifications for this loan. We're going to put, when we actually put up the website, or when we put the website with the Q&A, I'll put some key points on there. But think about the prospective view that you might have had 3 weeks ago on losing employees, losing customers, losing vendors, potentially not having bank financing, forecasting the slowdown today or tomorrow, all those factors playing a role in documenting your position at the time of the application. So, so I don't know if there's anything else. You saw my list of things, but I didn't want to go through them bullet by bullet.
Sure. I think the only thing that I would add to that is, one of the other pieces of economic uncertainty that you may be facing are, how are your suppliers doing? And are you at risk of losing suppliers, which is also going to cause another level of uncertainty that your company is going to be facing. And to the extent you can document that, keep that in mind, because that is, certainly a critical piece of information in that decision making.
Yeah, I think one other thing that may be unique. I've seen we got well over 200 people participating, and I'm not sure where they're all at, but Michigan has faced the right word probably isn't robust, but heavy restrictions with our stay-at-home orders from our governor, and those certainly play a factor. So, whether or not you're speculating they might get better or they might get worse, those put you in the mindset of where this program was designed to help you manage and navigate that uncertainty. So definitely for the companies here in Michigan, you may have been considered an industry that was really not essential in a shutdown. We have many clients who've been through a complete shutdown and now are looking forward to that place of getting back into business. So all those things will document your place in time, your position at this place in time.
And I think it's also, I sat in today on an economic webinar just that talked about the economic impacts of COVID-19 and how there's some trailing factors, and to make sure that you aren't, and we talked about it a little bit last week, just looking at your 13-week cash flow, but also maybe your cash flow through, your impact over the next 13 weeks, 2 quarters, 3 quarters, and because there are some businesses, while maybe not fully shut down, will have a trailing impact. And that is another economic impact that you may be demonstrating as your need for this loan to preserve some cash to weather that storm that's sort of trailing COVID-19. So keeping that in mind as well. It's not just necessarily, at least we don't think it's going to be unless we get guidance otherwise, it's not necessarily just the immediate economic impact. There is going to be a trailing economic impact. And, I think there's probably some people on here that may have sat in on the same webinar as I did. But in the industrial product segment of the economy, it's going to be even, while the retail and restaurant businesses have an economic impact right now, the industrial segment of the economy is going to see a pretty big decline, more prolonged and a little bit longer of a recovery. And so putting all of that information that you are gathering from, whether it's trade associations or peer groups, whatever it is, keeping that documentation is going to be, I think, critical. So if we sort of move on here, sorry. So we talked about loan forgiveness calculation last week. I didn't want to spend a lot of time on it again this week, but just sort of offer a reminder, especially for those of you that weren't able to join the webinar last week, that a lot of people, when this program first came out, they assumed that 100% of the loan would be forgiven if they used it all for payroll. And what we found when people started projecting that out is that in many instances, companies will not use the full amount of the loan just based on the maximum loan value calculation. They won't use the full amount of that loan in that 8-week period after disbursement. Which is the period that you have to use the funds in order to get the loan forgiveness. And so don't be surprised when you start getting into the loan forgiveness calculations to see that you, in fact, will have an amount that is not eligible for forgiveness before you even start looking at some of the reductions that are required, because the reductions that you are required to take against your loan forgiveness is the amount eligible for loan forgiveness. So I went through this example that showed, the total loan value was $2.5 million, but the total amount eligible for loan forgiveness was only 2.1 because that was the amount that was used. And if we sort of briefly recap the ways that $2.1 million would be even more, would be reduced even further, there are three things that could do that. The first item is that the amount of loan forgiveness will not, you cannot use more than 25% of the amount eligible for loan forgiveness on non-payroll costs. So if out of that $2.1 million, $700,000 or 30% of that amount was used for non-payroll cost items like rent, utility, or mortgage interest, you would have a further reduction of that loan forgiveness. The second item is the FTE count. If your FTEs are less than the base period, which is, we talked about that last week, but you look at your average FTEs from either February 15th, 2019 through June 30th, 2019, or January 2020 through February 29th, 2020. That's your base period. And if your FTEs during your covered period are less than that, you would have a further loan forgiveness reduction. In addition, there's a compensation. You can't reduce compensation for any one employee by more than 25%. And that calculation is an employee by employee calculation. It's not an aggregate calculation. So keep that in mind as you're going through this. We have some tools and we'll probably share them next week in a little bit more detail on these calculations. Or if you want to reach out to Tim, Ben, or myself, we can certainly help you with those. We didn't want to share them today just because we're still waiting on some clarity on a lot of these definitions. So there's still a lot of uncertainty around how some of this is really going to be implemented and operate in a calculation manner. Tim, did you have anything to add to that?
No, Sarah. Oh, sounds good.
Okay, great. So a few other considerations that we didn't quite get to last week that we wanted to bring up and probably talk about in a little bit more detail in future webinars if we've gotten all the guidance that we hope to have are, things to consider about PPP is how does this impact your traditional loan covenant calculations? Loan forgiveness cannot be accounted for until it has been approved. And what that means is that it's likely going to sit on your balance sheet as a debt. And that debt could have impacts on your general loan covenant calculations. You want to make sure that you are actively talking to your banker about this, because you don't, while intuitively you think, well, they should know, it shouldn't be a surprise. Be active in those conversations so that there's no surprise come your next reporting period to your bank where you've blown a loan covenant and now you're scrambling to try to get a waiver or to provide them more information. Try to be a little bit more proactive about that. We already said many companies aren't going to spend enough to reach 100% forgiveness. Make sure you factor those payments into your cash flow projections. They may not be much if your amount eligible for forgiveness or not eligible for forgiveness is small, but don't lose sight of that. That will impact your future cash flow. Strategize how you can maximize forgiveness. But, we sort of mentioned this last week, but only if it makes sense for your business. I said last week, don't let loan forgiveness drive your business decisions. If it's not something you would ordinarily do, reconsider whether or not it makes sense just to maximize forgiveness. Is the 1% loan something that you can handle and not that bad of a conclusion at the end of this? And then to the extent that you're trying to preserve cash flow, ask for rent deferment from your landlords before you're late. Don't wait until you're late to do it. You don't have to share with them that you've been a recipient of PPP. There's certainly been plenty of publicity out there about the struggles of small businesses to be able to get the loans. And if that's something that you think you're going to need, I would start having those conversations now. Don't do it after you've already missed a payment or are late on a payment. Similar to asking for deferments on other loans, a lot of the banks right now are offering 90-day deferments on your standard loan payments, but have those conversations before you make a loan payment. Your lenders are more likely to work with you before you're already in arrears. Same thing with your landlord.
Hey, sir, before you go ahead and move on, because I think we're doing pretty good on time for kind of towards the end here when you get into the questions 31 and I think 37, but there are a lot of questions that revolve around two issues. Number one, within this 8-week period, what's covered? So we've got questions from 3 months of rent to what about short-term and long-term disability policies? What about dental? What about vision? And so I think between the three of us, hopefully we can maybe just have a little dialogue that while there are many uncertainties here, how can we help the viewers here maybe put themselves in the best position?
Sure. Do you want me to handle that, or you want to give your
whatever you want?
There? Go ahead.
All right. Well, I think the key thing is to put yourself in the best positions to track all of these items. We're hoping by the 14th, we have some much better insight into what some of the guidance will be, maybe what some of the definitions will be, but it doesn't really make sense to put ourselves on the outside looking in on this. And so when I think of short-term and long-term disability or dental and vision, while there, or how about the fact that you may pay a premium for your employees, but then they reimburse a portion. Is it the gross or is it the net? These are all items that haven't been defined yet. And so we'll hopefully get more information. What we're suggesting is to really track all this information. You've got to have it at your fingertips. So when that time comes, you're able to include what the maximum amount you can include. But our candid answer is we're not sure about short-term and long-term disability. I've heard different people talk about if it's within a group plan, it would qualify. But if you go back to the law is pretty generic when it talks about healthcare costs, including premiums. And that's, I think, to cover companies that maybe are self-insured and don't necessarily have premiums for everything health related. So Ben, anything you would add on kind of trying to encapsulate as many of those things as possible?
No, I don't think so. I don't think you covered it.
Okay. And the other thing on the cutoff, we as accountants are struggling, like most of you are from your questions. What falls into this 8-week period? And I think I've answered some questions. When does my 8-week period, if it starts on a Wednesday, does it end on a Wednesday? Well, I think it probably ends on a Tuesday, 56 days in an 8-week period. Hopefully I did the math right that quick on 8 times 7, but we're thinking it's 56 days within that period that you've got to have incurred expenses and paid them. We're not sure about the payroll that's paid in the 8 weeks, but was incurred a little bit before it, or the payroll that's paid after the 8 weeks. We mentioned this last time. You may want to have a special payroll on the last day of your 8-week period to make sure you've covered everything you can. You still got those $100,000 limits. So you may have people who earn more than that in a year, but your forgiveness will still be limited. So I wanted to make sure people realize, because there's a ton of hypothetical questions about the various components of their payroll. And we can give you some good ideas. The best idea is to make sure you track it all. And hopefully we will know soon about dental, vision, short-term and long-term disability, provided they're provided in a group plan. What happens with those who've help contribute to their employees' flexible spending accounts. All those things are yet to be defined.
Yeah, it sort of goes back to planning or preparing for the best and planning for the worst, right? Track all of the potential costs that we think could be included. Prepare that some of those might not be included and prepare to live with that. But plan that you want your best case and your worst case scenario, and maybe you end up somewhere in the middle of those two. But if you don't plan for the best case scenario, you don't track those costs, you're going to be at a disadvantage when you go to file for your forgiveness. We don't know what that application is going to look like, but you want to put yourself in the best place to do that as fast as possible. So track all of those costs. And, I see one of the questions here is, our company covered the full COBRA premiums for the terminated employees? Can that be counted? We think it can. However, we don't know for sure until they tell us that. And there was some guidance issued on an employee retention credit, which is outside the scope of the PPP program, but was issued in the same legislation that the PPP program was issued. And that guidance has said no, that you don't get to count those payments as payroll costs, which also seemed contrary to the legislation that was written. So, while we lean that way, we sort of don't know where the guidance is going to go, because it's really been pretty liberal interpretation of the legislation that was written so far as we've seen.
Yeah, a couple other questions that have come up that I think are really good questions. And, as an accountant who's dealt with all different types of legislative changes over my career and clarifications with rulings or frequently asked questions or bulletins, so some of our participants are asking, great. One of the questions was, if I have somebody who resigns, how does that impact my full-time equivalent review? And to me, if you look at the intent of what they're trying to do with somebody who doesn't accept a job that you offer to come back, and they're going to put some provisions. Hopefully there'll be a provision in there for somebody who resigns as well, because you've got an open position there. You're offering them that job. But this is where we don't have necessarily an answer. We'd love to see that come about or come through by the 14th, or I keep saying the 14th. We've missed many deadlines in the rules that would require clarification from the Treasury and the SBA that haven't been met. So, what you may end up seeing is that July 15th or May 15th deadline to remit your loan money back if you determine you weren't eligible. We may see that move as they get, they need more time for further clarification. So a lot of really good questions related to hypotheticals with respect to employees. And same thing with full-time equivalents, although I think that's a little better defined from, I think and Sarah, I'm going to watch your head nod. We've got a 30-hour benchmark for a full-time equivalent. And if you got anybody below 30 hours, somebody was asking about part-time, you aggregate those employees to determine what's their full-time equivalent. So.
Yeah, and that's rules that exist in the standard SBA regulations today. So before the CARES Act was signed into law, the SBA had definitions already in place in their standard regulations, and that is one of them. Unless we get guidance that they're going to use a different definition, which I don't expect, that it doesn't seem, this definition is used for many places. It's used in Obamacare as well as the SBA. So this is a pretty common definition for FTEs. So I don't expect that to change. And I see a question in here that asks if you have overtime employees that are going to be working more, do they count as more than one FTE? And the answer is no. It's every person who works 30 hours or more is counted as one FTE. It's the part-time employees that you aggregate to get to what your FTE is. But one person cannot be more than one FTE.
Yeah, and there are a couple of questions about the difference that employees biweekly, monthly. You still got to annualize that income and divide and come to a weekly compensation to determine if they exceed the $100,000. So somebody was asking a question here about a biweekly employee. You're looking at $100,000 divided by 52 is going to be your weekly payroll times 8, $15,384. So if you've got an employee that's earning more than that in a 2-week period, you've got to reduce your forgiveness. That may be their compensation, but the forgiveness you consider would have to be reduced.
Agreed. And,
okay.
see a lot of questions about prepayment. These are a lot of the hypothetical questions that we sort of went through last week that we hope to get guidance on. I think Tim has more optimism than I do that we're going to get that guidance by next week. The legislation said that the SBA had 30 days from enactment of that legislation to issue guidance. We've blown past that already. And the SBA seems to recognize that it's taking them longer to get this guidance out. And there's a lot more questions out there than they can necessarily handle, in addition to processing all of the loan applications. So, I think that it is more likely than not we'll have guidance as it relates to what are adequate sources of liquidity for purposes of this certification. But I'll be surprised if some of these more nuanced questions are answered as far as, if you prepay rent, will it count as your rent expense? And, am I going to have to run a special payroll to maximize my payroll costs, or are my payroll costs, can I accrue payroll for what's been earned? I don't know that we're going to have those answers next week. I was hopeful that we were going to have them this week, but that has not been the case, obviously.
I know in hindsight, I feel like maybe we should have had these on Friday, because 7 days from today is the 13th, which will be 1 day before they say they're going to have this information, and 2 days before the deadline will be for companies to possibly return the money. One thing I'll say on returning the money is I think everybody is pretty much in consensus, which is wait to get more information. We're hopefully going to get more information, so wait to get more information.
Wait to get more information. The unfortunate result of that is that if they come out with guidance on May 12th, some people received the funds, in the first week of April or the beginning of April. So they've already made business decisions that they have qualified for the loan and would have made other business decisions, maybe would have laid people off had they not gotten the PPP loan. And if this guidance shows that, there's some bright line test and they wouldn't have qualified under that bright line test, they're already stuck with the business decision. So they're already in a bad position. I don't think that that's where this is going to go, but I've been surprised with some of the guidance that's been issued all along. So I don't rule anything out. Unfortunately, we're in a position, business owners are in a position of having guidance come out after the fact. And I think that there's a lot of, I've read a lot of legal analysis articles that sort of discuss what how legal it is and whether or not there can really be, what recourse the government's really going to have other than you're not eligible for loan forgiveness. And I'm not sure where we will end up, but I think that there's, dealing with so much uncertainty after you've already received the funds is a bad place to be.
Got about 12 minutes left, so since I am also the clock, why don't you go ahead and kind of get to your kind of some of your final points, and if we've got some ability to answer some final questions, we can go ahead and do that.
Sure. So I think a few other considerations, and these are similar, these are sort of repeats from what we talked about last week, is, really looking at your cash flow analysis with and without loan forgiveness, and how much does that forgiveness change any business decisions that you're making today. And if you look at it and say, this loan forgiveness is not the driver of decisions I'm making, then I don't know that I would change what you're doing. I don't know, there's a lot of people who are saying, well, should I just pay my employees to not do work? Right here in Michigan, a lot of the manufacturing plants are idle right now. They're not essential. And so you plant employees who don't have a job to go to. And does it make sense to pay those employees? You know, that's a decision that you have to make. But if you wouldn't make that decision ordinarily, you know, you can look at the ethics of it is, well, I'm going to do it because I got this loan. Without this loan, I wouldn't do it. That's okay. But you also have to look at, will this loan help me once I get back into business? I know there will be a delay in when cash starts coming back in the door. And that's really the purpose of this loan, is to help me cover that period. And so don't be short-sighted as you look at what to do with these funds and how you're making decisions. And then, you know, we still don't know, once it is a loan, does it matter what you spend it on? Or do you still have this qualified uses of the loan? And so you still need to track those funds. And this is really, I think, a question for all of those businesses that have received a loan that's over $2 million. You know, even if you apply for loan forgiveness, we know that those loans are going to be reviewed. How much those loans are going to be reviewed, I think, you know, while the SBA says all loans over $2 million, if I look at the statistics as of May 1st, there's over 33,000 loans that are over $2 million. And the legislation says that banks have 60 days to make a decision on forgiveness. So if you are a borrower that submits an application for forgiveness, the SBA or the lender only has 60 days to make that decision. But the SBA says that they will look at it once an application for forgiveness has been received. We'll see if the guidance stipulates that that decision also has to be made within 60 days, because I think that will change the tune of how many of these loans really are able to be reviewed. And when I look at the statistics, you've got 33,000 over 2 million and less than 6 over 5 million. So that, you know, where that pool really ends up, I think is to be determined, even though the legislation allows them to audit. I don't know, practically speaking, that they will be able to. And then, you know, we talked a lot last week. Should you give the funds back after those FAQs were issued? Tim alluded to this earlier when we were talking, and I don't think, you know, I wouldn't suggest, unless you are specifically, you know, the LA Lakers, I wouldn't suggest that you give those funds back until the day that they're due if you think you have an issue. I wouldn't necessarily go back today without guidance that tells us exactly how they're going to look at this certification. I wouldn't do that. I'd wait until you get that guidance. Tim, anything to add there?
That's great advice. I think, you know, I can't say enough about the difficulty as a professional in not knowing what the hindsight will, for this oversight will look like. Very difficult. And I certainly have empathy for all the businesses out there and how you navigate this. And somebody's asking a question right now, will 8 weeks be enough? You know, in Michigan with automotive production and things, is 8 weeks really enough? You know, you've seen them move in different areas. You've seen them extend now this safe harbor return of the funds. We've seen what they're calling, you know, 3.5, you know, stimulus package 3.5, which was the second tranche of funds for the PPP program. And I don't know if this will go beyond 8 weeks. I know that at some point in time they used an 8-week measurement to say we can get through this. And I'm going to speculate that it may have been with whatever information was available from other countries as they were dealing with this virus as it was coming to us, whether that was China or Europe, I don't know. But I really don't have an idea on whether this 8 weeks will be enough, or how the oversight from the SBA and Treasury Department will come through. But I think making sure people document more than less and making sure you track as much of your spending as possible is going to be critical to being on the, at least maybe give yourself a little bit more, put yourself on a higher level or threshold of qualifying and meeting the maximum loan forgiveness.
Yeah, I agree. You know, I think they issued we all know they issued the legislation really fast, right? They 5 days of negotiations and issued this legislation. And so there's a lot of holes in it. And I'd like to say the SBA is doing the best they can to address those holes. I think they're taking a lot of liberty in addressing them, but I think it's going to be hard to change the 8 weeks because that is in the law. And I think that we would need for the next phase to be issued for that to happen. I don't know how fast phase 4 is going to come together. Right now, from the sounds of it, that they're pretty far apart. Congress is pretty far apart, the Democrats and the Republicans, as to what's going to be included and how much they're willing to include in that next round of legislation. And from what I'm hearing so far, that the small businesses, this isn't a part of it, or won't be as big a part of it if there is something in there. They're really focusing, the Democrats are really trying to focus on states and hospitals. And I think the Republicans are focusing on some of the larger industries and some of the bigger corporations and what that bailout looks like. But it's to be seen. But I do think that it's not going to be something that's able to be issued in an FAQ that is extended, because it's clear in the legislation that it's 8-week covered period.
Mm-hmm. So we have 4 minutes. Ben, you're watching the questions like I am. Is there anything out there that you want to throw out to the panel here or to us? It's a very intense look, Ben. Very intense. There you go. There you go. This is fun stuff.
Ben?
We can't hear you, bud.
Go back on mute.
Yeah, go back on mute there, Ben. Those earbuds failed. Sarah, there is one thing I don't know. Well, there's a lot of things I don't know, but there have been more hypotheticals in the questions about this 8-week period and how they determine the 100,000. If I furloughed somebody for a week, is it 7 weeks then? As far as when I'm considering the annualization of their income, is it 7 weeks at the weekly equivalent? We've got some people are talking about accelerating pay into this 8-week period. What is your understanding of how they would visit or how they would determine the compensation within an 8-week period?
I also don't know the answer to that question. Most of the models I've seen look at it based on your weekly pay. Mm-hmm. And I think most of those models do it that way because there's a mismatch in the periods, right? And the maximum value of the loan, which is 2.5 months, and this 8-week period, there's that mismatch. So instead, and then there's like a quarter, there's a 13-week look at. So I think instead they're just looking at, okay, my weekly salary is X times 52, what does that equal? But I don't know the answer to that.
Okay. All right, good. And then I don't think anything's changed. I think if you go back to April 3rd, the first day of application, where there were certainly professional payroll companies that were helping companies do calculations, maybe not totally correct in hindsight, but there were a lot of discussions about 1099 employees. And I think there's been some clarification, but somebody's asking a question where when they first did their application, they were under the presumption that 1099 contractors were included and therefore were included in the amount of the loan they determined. And what's the stance on that now?
The stance is that the SBA came out and said no, that they're not included. And that's because your 1099 contractors could apply for their own loan. And so there would be that double JIP that would be available out there. And so they've excluded 1099 contractors from payroll costs for businesses. I will say, going back to, there was a lot of information coming out for payroll companies, and a lot of it when it first came out was wrong. And I'm seeing that trend start to happen again on loan forgiveness spreadsheets. A lot of people are issuing spreadsheets that are out there, and I just caution everybody that those may not be accurate. You can use them to do projections, but don't rely on them as being what your final conclusion is going to be, because there will probably be changes as we get guidance.
Okay. Well, we are at 3:59, and so I want to wrap up just with one more housekeeping. We're going to do this again next Wednesday at 3 o'clock. With any luck, I'm going to keep my fingers crossed that we'll have some new insight, possibly some new definitions. I know the way that they're doing the frequently asked questions, we'll have some more frequently asked questions. But my last comment to those people that are out there, we're right about 200 participants still online, would be you really need to put yourself probably on the front end of this if you qualify and if it was necessary. I think everybody has a different risk profile. If you talk to your lawyer, you talk to your banker, you talk to your accountant, you talk to your controller. The other thing that's not clear is who signed the application. Was it an agent? Was it a CFO or a controller? Was it one of the owners? And I think those things will play out in this, but everybody's got to make their own assessment. I think the necessary and the impact, the necessity of the loan and the impact that the COVID might have on your business is all subjective, and nobody can give you black or white. But you still got to look at yourself and determine where do you feel as we get closer to May 15th. So, with that, we're going to say thank you to everybody. Sarah and Ben and I will continue to type some answers on questions. Look for a follow-up email that will show you where the video is posted and then where our Q&As will be posted so that you can take a look at those as well. Can't thank everybody enough and look forward to seeing everybody again. Not actually seeing you next Wednesday, as Sarah let you know, but hopefully you think I'm seeing you next Wednesday at 3 o'clock. So thanks, everybody.